Good morning, everyone, and thank you for joining me today. We're going to dive into the comprehensive auditing of the acquisition and expenditure cycle. Throughout this presentation, we'll explore key principles and procedures, identify potential risks, and also look at how technological advances are shaping effective financial oversight. I'm excited to share insights that will help strengthen our auditing practices and ensure greater accuracy and control in financial management. Let's get started. The acquisition and expenditure cycle is essentially the process a company follows to purchase goods and services and then make the corresponding payments. This cycle is fundamental to business operations since it covers everything from the initial request for a purchase all the way through to the final payment. From an auditing perspective, this cycle is crucial because it directly impacts the accuracy of financial reports and how efficiently the organization operates. When auditors examine this cycle, their main focus is to verify that every transaction has been properly authorized, accurately recorded, and fully completed. This helps ensure both compliance and integrity in the company's financial activities. When auditing the cycle, our first key objective is to verify the accuracy of transaction recording. This means we need to make sure every transaction is recorded correctly to avoid any errors or misstatements that could affect the financial statements. Next, we focus on completeness, ensuring that all valid acquisitions and expenditures are included. This prevents any important transactions from being overlooked or omitted. Lastly, we check the validity of transactions by confirming that each one is legitimate and properly authorized according to company policies. Together, these objectives are essential for confirming the reliability of the financial statements and ensuring the company's compliance with its internal controls and standards. Here, we focus on three key documents and transactions essential in any purchasing process. First, purchase orders. These are official documents that authorize a purchase and clearly specify the goods or services we intend to acquire. Next, we have invoices. These are requests for payment that provide detailed information about what was purchased and the amounts due. Finally, receipts serve as proof that the goods or services have been received. Together, these documents help keep the purchasing process transparent and well organized. Internal controls play a crucial role in the acquisition and expenditure cycle by helping to prevent errors and fraud. One key aspect is ensuring that every purchase is properly authorized, which helps maintain accountability and control over spending. Another important function of internal controls is to protect company assets, reducing the risk of loss or misuse. Common control mechanisms you'll often see include approval hierarchies, where different levels of management must sign off on purchases, and careful reviews of purchase requisitions before orders are placed. Additionally, verification processes like reconciling invoices with purchase orders and receipt records act as a final checkpoint to confirm that what was ordered matches what was received and billed. These controls together create a robust system that promotes accuracy and security in financial transactions. Segregation of duties is all about dividing responsibilities among different people to minimize risk. For example, in a business setting, you might have one person in charge of purchasing, another responsible for receiving the goods, and a third person approving payments. By splitting these tasks, we reduce the chances of fraud or mistakes because no single individual has control over the entire transaction process. This separation acts as a crucial control mechanism, helping to maintain honesty and accuracy throughout the acquisition and expenditure cycle. It's a key practice for protecting the organization's financial integrity. Vendor selection controls play a crucial role in ensuring that the process is both legitimate and fair. By formalizing how vendors are evaluated, we create a structured approach that helps prevent bias and arbitrary decisions. When it comes to vetting vendors, we look closely at key criteria such as price, quality, and reliability to make sure we choose partners who meet our standards. Before we engage any new vendors, it's essential that the approval comes from authorized personnel, adding an extra layer of oversight. Beyond the initial selection, we also conduct periodic reviews of vendor performance to ensure they continue to meet our expectations. Altogether, these measures help protect us from conflicts of interest and reduce the risk of fraud, keeping the vendor management process transparent and accountable. When we look at common risks and fraud indicators in the cycle, there are several key points to keep in mind. First, unauthorized or fictitious purchases are a frequent risk, where transactions occur without proper approval or are completely made up. Another significant concern is duplicate payments, which can happen when the same invoice is paid more than once. Overpayments and kickbacks are also critical issues. These can involve paying more than necessary or receiving improper incentives tied to transactions. Missing or altered documents often signal potential fraud, so it's important to watch for any gaps or changes in paperwork. Unusual vendor payment patterns, such as irregular timing or amounts, can also raise red flags. Lastly, discrepancies among documents, whether between purchase orders, receipts, and invoices, are strong indicators that something may be amiss. Being aware of these risks helps us maintain control and integrity throughout the cycle. When auditing purchases, it's essential to start by verifying purchase orders to ensure they have the proper authorization. This step helps confirm that all purchases were approved by the appropriate people. Next, we perform invoice matching procedures, where we compare invoices with corresponding purchase orders and receiving reports to ensure consistency across documents. Accuracy checks follow, where we confirm that the prices and quantities billed are correct and align with agreed terms. Finally, cutoff testing is conducted to verify that transactions are recorded in the correct accounting period. Together, these audit procedures help validate the existence, accuracy, and validity of purchase transactions, providing confidence in the financial records. When auditing cash disbursements, the first step is to confirm that all payments are properly authorized according to the company's policies. This helps ensure that no unauthorized or fraudulent payments are made. Next, we verify that each disbursement matches a valid invoice and corresponding receipt documentation, confirming that the payment was legitimate and supported by evidence. It's also important to review any cancellations or voided checks carefully, as these can sometimes indicate irregularities or attempts to conceal improper transactions. Finally, we reconcile all cash outflows with the accounting records to make sure everything is accounted for and complete, providing an accurate picture of the company's financial activities. These steps together help maintain strong control over cash disbursements. When auditors conduct their work, it's often impractical to examine every single transaction, so sampling becomes essential. The main purpose of sampling in auditing is to test a representative subset of transactions, which helps auditors draw conclusions about the entire population without reviewing everything in detail. One common method is random sampling, where transactions are selected randomly to minimize bias and ensure a fair representation. Another technique is systematic sampling, which involves selecting every nth item from a list, providing a structured yet straightforward approach. Then there's judgmental sampling, where the auditor uses their professional judgment, often focusing on higher risk areas to prioritize resources effectively. Overall, sampling not only makes the audit process more efficient but also maintains a reasonable level of assurance about the accuracy and reliability of the financial information. When evaluating vendor relationships and transactions, auditors take a comprehensive approach. First, they carefully examine the contractual terms and check for compliance, ensuring that the agreements align with company standards and regulations. Next, they review historical transaction patterns to spot any unusual or suspicious activities that could indicate risks or irregularities. Another critical aspect is verifying that vendors consistently follow company policies, maintaining transparency and trust. Finally, auditors investigate related party transactions closely, as these can sometimes lead to conflicts of interest or favoritism. This thorough evaluation helps identify potential risks and safeguards the integrity of the vendor management process. When testing compliance with company policies, the first step is to verify that procurement activities are following the established authorization procedures. This ensures that every purchase is properly approved before moving forward. Next, we check adherence to the approved vendor lists, making sure that purchases are only made from suppliers that have been vetted and authorized by the company. Third, it's important to confirm that payment terms and limits are respected, preventing any unauthorized financial commitments or overpayments. Lastly, we need to confirm that segregation of duties is maintained throughout the process, which helps avoid conflicts of interest and reduces the risk of errors or fraud. Together, these steps help guarantee that all acquisitions comply with our internal standards and policies. When we talk about cutoff testing procedures, the first step is to carefully review all documents around the period end, such as purchase orders, invoices, and receiving reports. This helps us ensure that everything is recorded in the correct accounting period. Next, it's important to confirm the timing of goods received. We need to verify that any goods received before the period end are properly recorded, and nothing is missed. Finally, we must ensure that payments made after the period end are not recognized too early. This prevents any misstatements in financial reporting and keeps everything accurate. These steps are crucial for maintaining the integrity of our period-end financial data. When auditing payroll and related expenditures, the first step is to verify employee authorization and positions. This means confirming that each individual on the payroll is actually authorized to be paid and holds a legitimate position within the organization. Next, we test the calculations of wages, deductions, and benefits to make sure everything adds up correctly and complies with relevant policies and regulations. It's also crucial to confirm that payments align with valid attendance records, ensuring that employees are paid only for the time they have actually worked. Finally, we review related expenditures such as payroll taxes and employee reimbursements to verify that all costs associated with payroll are accurate and properly accounted for. Together, these steps help ensure the accuracy and completeness of payroll reports. When we talk about using analytical procedures, one of the key techniques is trend analysis. This involves comparing current period expenses to those from previous periods or against budgeted figures. It helps us spot patterns or changes that might need closer attention. Next, ratio analysis plays a crucial role. For example, examining ratios like purchases to sales or expenses to revenues can give us insights into how the business is performing relative to itself over time or to industry benchmarks. Another important aspect is detecting fluctuations. By identifying unusual or unexpected changes, we can pinpoint areas that may require deeper investigation to understand the underlying causes. Overall, these analytical tools are essential because they allow us to efficiently uncover potential errors or irregularities, enabling a more focused and effective review process. When we look at common audit findings in acquisition and expenditure, there are a few key issues that come up regularly. First, missing documentation or incomplete records is a frequent problem. This can make it difficult to verify transactions and ensure everything is accurate. Second, unauthorized purchases or payments often surface during audits, highlighting the need for strict controls and approvals. Third, non-compliance with vendor approval processes is another common finding, which can lead to risks in vendor management and potential conflicts of interest. Lastly, errors in recording amounts or account coding are typical issues, which can affect financial reporting and decision-making. Being aware of these common findings helps us strengthen our controls and improve overall processes. When conducting an audit, it's essential that auditors gather evidence that is both sufficient and appropriate to back up their findings. This means the documentation must be robust enough to provide a clear and reliable basis for conclusions. One of the primary types of documentation includes purchase records, such as copies of purchase orders, invoices, and payment vouchers. These documents help verify the legitimacy and accuracy of transactions. Another crucial set of documents involves receipt and approval evidence. Receiving reports confirm that the goods or services were actually received, while approval signatures demonstrate that the transaction was authorized properly. Lastly, additional important documents include vendor contracts and any correspondence. These help clarify terms, conditions, and any ongoing communication that might affect the audit's outcomes. Together, all these pieces form a comprehensive body of evidence necessary for a thorough audit. When reporting findings, it's crucial to clearly describe each issue and explain how it impacts the financial statements. This helps everyone understand the significance of the problem. Next, provide concrete evidence and examples to back up each finding. This adds credibility and makes the issues more tangible. It's also important to include recommendations for corrective actions, offering practical steps to address the problems identified. Finally, present all findings in an organized and objective way. This ensures that management and stakeholders can make informed decisions based on accurate and unbiased information, promoting accountability throughout the process. In this case study, we examined the audit of a manufacturing company's purchases. The scope of our audit focused on reviewing purchase orders for raw materials to ensure they were properly authorized. We then moved on to the verification process, where we confirmed that the receipts matched both the invoices and the production records. During this process, we identified some discrepancies between the quantities ordered and those actually received. Based on these findings, we recommended improving inventory controls and vendor management to prevent such issues in the future and enhance overall purchasing accuracy. In this case study, we focus on detecting fraudulent expenditure. One of the key indicators was unusual vendor payment patterns, especially excessive recurring payments that didn't align with regular business activities. This led to the discovery of fictitious vendors, which were supported by forged approvals, highlighting serious gaps in the approval process. To uncover these issues, we applied advanced data analysis techniques that helped identify anomalies and suspicious transactions buried within large datasets. As a result, we were able to implement stronger controls over vendor management and payment authorizations, significantly reducing the risk of future fraud. This case really emphasizes how crucial constant vigilance is when it comes to detecting and preventing fraud in any organization. When auditing the acquisition and expenditure cycle effectively, the first step is to plan carefully by gaining a deep understanding of the cycle itself. This helps us identify the key risks and control points that need our attention. Next, it's crucial to test controls thoroughly, especially those related to authorization, approvals, and segregation of duties, since these areas are common sources of weakness. Alongside this, analytical procedures are essential. They allow us to compare current data against benchmarks, past trends, and expected results to spot any unusual patterns. Finally, documenting and communicating our findings clearly is vital. Keeping open lines of communication with the auditee ensures issues are resolved promptly. Plus, well-documented evidence supports our conclusions and recommendations, making the audit process transparent and credible. When we talk about technology's role in auditing acquisitions and expenditures, there are several key areas to consider. First, automated data extraction from ERP and accounting systems helps reduce manual errors and broaden our audit coverage, making the process more efficient. Then, audit software tools come into play by improving consistency through risk assessments, workflow management, and sampling, allowing us to focus our efforts where they're most needed. Data analytics is another powerful tool, enabling us to spot unusual transactions, duplicates, or anomalies, which supports more thorough forensic reviews. Real-time monitoring through dashboards lets us detect control failures or policy deviations quickly, so we can act proactively. Additionally, electronic working papers standardize documentation and make collaboration and review much smoother. Finally, emerging technologies like artificial intelligence and machine learning are revolutionizing risk modeling by enhancing pattern recognition and providing predictive insights, which ultimately strengthens our audit processes. When we look at the challenges in auditing, several key issues stand out. Complex transaction flows and multiple approval layers can make audits much more difficult to navigate. Incomplete or inaccurate documentation often limits the evidence we can gather, and rapidly changing regulatory frameworks add a layer of uncertainty about compliance requirements. Additionally, resistance from auditees can hinder access and cooperation, which slows down the process significantly. To address these challenges, developing detailed process maps and internal control questionnaires is essential. These tools help us gain a thorough understanding of workflows and identify potential risk points early on. Promoting early engagement and maintaining transparent communication with auditees builds trust, making it easier to share information and resolve issues collaboratively. Staying updated on regulatory changes is also critical, and this requires continuous professional education and utilizing industry resources to keep pace with evolving standards. Finally, leveraging technology plays a crucial role in modern auditing. Automating testing increases data accuracy and reduces manual workloads, while employing risk-based audit approaches helps us prioritize significant areas, ensuring resources are allocated efficiently. By combining these strategies, we can effectively overcome auditing challenges and deliver more reliable results. To wrap up, let's review the key points. First, a comprehensive audit process is essential. This means thorough planning, carefully assessing risks, and testing controls throughout the acquisition and expenditure cycle. Next, technology is a game changer. It enhances audit accuracy, boosts efficiency, and broadens the scope through automation and advanced data analytics. However, auditors do face challenges, such as dealing with complex processes, handling documentation issues, and keeping up with regulatory changes. But with well-thought-out strategies, these obstacles can be effectively managed. Maintaining audit quality hinges on clear communication, diligent documentation, and a commitment to continuous learning to adapt to new risks. Finally, optimizing audit effectiveness relies on taking a risk-based approach and harnessing modern tools, which ultimately supports trustworthy financial reporting. Now, I invite you to ask any questions or seek clarification about auditing the acquisition and expenditure cycle. Feel free to bring up anything that might be unclear or that you want to explore further. We can also discuss various topics such as audit methodologies, how technology can be integrated into the process, managing risks effectively, and some of the practical challenges you might face during fieldwork. This is also a great chance to share your own experiences, clear up any uncertainties, and exchange best practices that can help improve our audit outcomes. Remember, your participation is really valuable. It not only helps deepen everyone's understanding but also sharpens the strategies we use in our audits. So please, don't hesitate to contribute.